Hi, guys. Welcome to yet another episode of Stoic Talks Season 2. This particular episode is brought in collaboration with DSP Mutual Fund. Now, in this episode, we converse with Ravi Dharamshi, founder and MD of ValueQuest Investment Advisors. Now, Ravi was fortunate to be born and brought up in a family with very deep equity culture. But as we discuss, his venture into equities was anything but planned. Now, it has been 22 plus, years of investing experience for him, but his most cherished experience was his early days when he worked with and under the guidance of the late Rakesh Jhunjhunwala. Ravi's investing process has evolved over the years, but his investing style is deeply influenced by Rakesh ji. In this episode, while we do explore the great Rakesh Jhunjhunwala from the lens of an insider, we do focus and dig deeper on Ravi's investing style and his investment philosophy. So let's tune in. Hey Ravi, how are you? Welcome to Stoic Talks. Great having you here. Nuresh have introduced me to you in past, and I was always wanted to talk to you in on this platform. So good to have you here.
Thank you so much, Puneet, and thanks, Nuresh. It's my pleasure. Earlier I didn't believe I was worthy of being coming on your platform.
So that's being humble, or however you want to put it. But we'll keep chasing you even for the next series.
Absolutely no. You have all access to me, no issues. In fact, I admire the work you guys do, and I truly do follow everything that you guys put out there.
Great, yeah, good to know. So, Ravi, let's do one thing. For the benefit of listeners, we just generally the first question we always ask all our guests usually is to give an introduction to how you got started to the markets. Uh, Whether your family was into it, and how do you got introduced to stock market in the first place, and then eventually what have been your journey, at least till the start or till the time you become professional money manager that you are today.
Sure, sure. No, absolutely. I think, in hindsight, it looks like it was always meant to be, but that's not how it was when I started out. Like any other young kid going through school, college, had no idea what he wanted to do in life. I was not one of those uh, super bright kids who had clear vision and focus on what he wanted to do in life. I was not that. I was good. I was an above average in academics, but I was still keeping my options open. I didn't know what I wanted to do. In fact, this was in the late 90s, and all the buzz around that time was the dot com and internet. So yeah, even you might not believe. I mean, I have done commerce, and then I did law, and then I did my MBA in finance. But in between, I had even done kind of a diploma course from NIIT for tech, and I have also done 6 months of a very very intensive diploma in advanced computing, which is from a institute called CDAC, which is responsible for our the supercomputer that India has, Param. So, I mean, there was a active thought process to get into the technology side of the business world rather than come on the market side. Now, when I was in my college days, I used to, kind of go to office. My family has always been in equity markets, so that option was always available to me. But I mean, I was more casual. I had a very casual attitude towards the markets. I mean, this option is always available, so I used to go to office and was fascinated somewhat with what was happening, stock prices going up and down. I clearly remember when I was still very young, maybe in first year of college or something, my brother actually took me along to those were still the days when the ring was there. In fact, I was not in college, I was in school, school holidays or something, and he took me to the ring. And there is something called as Vanda session that used to happen every 15 days, where all the discrepancies in the trade used to get resolved. And I could not make head and tail of what this was. How in this large room can people, shout at each other, make sign languages, and make trades? It did not make any sense to me. But it was fascinating nevertheless, and even at that point of time, one could not help but feel that awe around, the building, the environment, and you could feel that there is a certain vibe to that particular place. So clearly, it I mean, eventually it all ended up being part of my subconscious, which led me to take the decision that, you know what, this is where I need to be. But honestly speaking, the decisive moment came for me when I went to US and I was doing my MBA. I actually got a lot of time, to do a lot of reading. Prior to that, I was a college kid who just wanted to have a good time in life. And at that point of time, I got really serious about my education, non formal education way of getting educated, also, like making connections, reading books, understanding how money has been made in the past. I would have read up like 40, 50 investment books over a course of 3 months. And those were the times which were still the early days of internet, 99 2000. So a lot of all this material was available on the internet, and that was kind of fascinating that you suddenly had access to so many things. So anybody at that stage, would want to take advantage of free knowledge that was available. So that is, I think, where I decisively became clear that I wanted to get in the market. However, I didn't want to come back to India still at that point of time. I still wanted to probably do a job. I got an internship in Solomon Smith Barney, which now does not exist as of today. It actually became part of City at one point of time, Travelers Group, and then I guess it got merged. So during that internship, I was very keen to do a job, and my boss was actually quite fond of me. So I was very hopeful that I'll get a job over there. Unfortunately, 9/11 happened during my prior to my graduation. So I graduated in May of 2002, and 9/11 was September 2001. And at that point of time, besides the two twin towers that fell, there was one more building that fell, and that was where the Solomon Smith Barney main office in New York was. And after that, there was chaos. Even the Harvard graduates who had gotten an offer were getting their offer rescinded. So I knew it was a pretty bad and tough situation. And I was like, okay, even at that point of time, it was a temporary thing that I will stay back, we get some experience, 3 4 years. I mean, of course, I don't know if things would have taken a different turn at that point of time, but my bent of mind was to come back to India. So then I was like, okay, you know what, if this is tough time, right, let me just come straight back to India. And I think that was the luckiest break that I got, because I came back and I joined Rakesh Jhunjhunwala, and India had the best bull market of our lives in the last 3 decades. So that was a learning and earning period like no other. So I can't, thank enough my stars that I actually ended up being in the right place at the right time.
And how did that transpire? I mean, how did the first job you landed was with Mr. Jhunjhunwala?
So, of course, Rakesh ji was a good friend of my brother, and that played a role in that, of course. But that was also the time, again, as I said, right place, right time. He used to be a one man army. He did not have anybody besides an accountant and some staff working for him. And at that point of time, he decided to build his team. So that is, I guess, that is where stars again got lucky for me. Utpal Bhai was the first one who he got on board. And of course, there were many other in the process that were going to join. But since I had just come back from US and I really did not have anything else to do, I joined him as well. I very clearly remember when I joined him, it was still his old office in Vittal Das Chambers. And I mean, it was honestly not an office fit enough for a man of his size and stature. But that's the way it was. I mean, he was very attached to that particular office. It was very right next door to Bombay Stock Exchange. It worked for him, but then of course, because he had started building his team, so there was a need to move. So we moved to Nariman Point few months after I joined, and yeah, then the story began.
Generally, I have noticed with many people that the first job they pick up in equity markets end up becoming the kind of investor they become. Obviously, things evolve, things change, but the underlying principles comes from the first key job you do in the markets. Be it a chartist, or be it a momentum guy, or somebody like that. So would you say that your investing style today is a pretty much a reflection of how you have learned your ropes from Mr. Jhunjhunwala in the starting days, or have things changed dramatically different for you? How has that journey been post you become an equity market participant?
No, no, absolutely. There is a very heavy influence of Rakesh ji in my thinking, thought process, action. However, I would like to say that a lot of influence has come from my brother as well. I used to be working with him during my college days, and a lot of my principles in life I have learned from him. So, Rakesh ji has obviously a huge sway over, especially the ability to decide, the ability to take calls, the ability to deploy large money. That I have learned from Rakesh ji, and I have been first hand witness to some of the decisions that he's taken, and it used to shock me, to say the least. Or I mean, I used to be, how can somebody like that decide now? But now, with 20 years of experience behind me, I can understand that he was not taking quick decisions. He has actually been going over that thought process, or he has seen that movie play out again and again in front of him. It's just the sheer accumulation of experience, knowledge, that enables you to take those decisions quickly. So obviously he was a very astute mind, and he was a very quick judge of a person's character, very quick judge of business potential. And then I mean, if once he's made up his mind, you cannot change it. Doesn't matter who you are or what you are. It was the most difficult thing on this planet, is to change Rakeshji's mind about something. So that will just tell you that you have to be really on top of your game. You have to be very, very your numbers have to be on your hand, and you cannot go and bullshit to him, honestly. So I have learned a lot from him about all those aspects. From my brother, of course, because I mean, you mentioned my brother is actually known as a technical chartist. That's how he started out. And in his past, he used to actually have those pink large sheets and make almost almost 150 200 charts. He used to make by hand every day. He used to plot that candlestick, or not candlestick, I think bar chart is what he used to make. So those were the days prior to the advent of the softwares, and he used to do that. So I was influenced by that as well. Now the way it has influenced me is not that I use technical analysis in my investing, but what charts tell you is the demand and supply in that stock. And when key levels get broken, you need to understand that. So for example, today we are at an all time high. What one needs to understand is that no investor, okay, doesn't matter what time he has come, is losing money at this point of time. I mean, of course, one could be losing money by invested in a wrong stock, but overall, as an aggregate in market, nobody is losing money because it's at an all-time high level, and market cap is at an all-time high level, not index. So now that human psychology plays a big role, and human psychology is what is reflected on the charts. So and it's not like Rakesh ji looked at the charts and he understood anything technical analysis or something. In fact, he had a kind of disdain for technical analyst, that there is no technical analyst who lives south of Sion. But even he knew the importance. I mean, his friendship with my brother was clearly because he respected his views in the market. You need to be able to see as is. Finally, what I would say my brother's strong point is that he's happy to admit when he is wrong, and just take a corrective action. And a lot of times we actually get stuck in our own biases. How can I have bought and I have made a statement publicly that I'm bullish on this, then how can I go back on my words? I cannot sell this in my trading position. All those kind of things muddle your thinking. So it is great to have a sounding board who can make you see the picture as is rather than what you want it to be. So I think those qualities are what I have learned from my brother. And again, I don't use technical analysis on a daily basis or anything, but if there are key points, key events key things happening in the market, extreme events are are panning out, then one has to take cognizance of that.
Sure, sure. So let's do one thing. I mean, Rakesh ji has been favorite investor of entire country, right? Everybody has seen him. You have the fortunate,
I am very privileged to have seen him up front, close and personal, and in action.
yeah. So before we get into your style of working, how about a couple of anecdotes that you remember? You mentioned quick decision making. You mentioned not able to change his mind. Something which had a huge influence on you. You still remember. You sometimes cherish, and sometimes when you're sitting and thinking about him, probably you enjoy those thoughts. Any such thing comes to your mind?
No, there are tons and tons of those, but I'll give you two, three anecdotes. So once this particular company, should I name it? Okay, let me name it. It's been a while now. It's been almost 20 years. There's a company called EduComp that was going private. Sorry, that was going public, and they had come to the market. I remember Gaja Capital was one of the investor, and they had come along with them, and they were going public, and they were pitching to Rakesh ji to invest in the IPO, and the market cap at which this company was coming out for an IPO was 125 crore. And I mean, 125 crore today does not seem like a big number, but at that point of time, I mean, Rakesh ji, I remember at the I mean, the guts to ask the promoter that, do you know how many zeros are there in 125 crores? Have you ever seen an amount like that? So actually, he was very clear in his mind that this is not a business model that can sustain itself. They were actually selling hardware, and all the top line was basically coming from selling of hardware, and there was no so much software involved. So at that point of time, I was too young to understand his rationale for not going ahead with this particular investment. But along the way, it became clear. Though initially that company went from 125 crore market cap to almost 4-5,000 crore market cap in the peak of the bull market. So at that point of time, it looked like, why would you not invest if 125 crore would go to 4-5,000 crore? And I used to constantly ask him these questions, and he was like, you do not focus on the potential, focus on the probability. So even though that market cap had come through, but it was not a sustainable market cap. He always knew there was a flaw in the business model. So that is one anecdote that I remember. Then second anecdote that I remember is there is this one private equity investment that it did. We flew down to Ahmedabad to meet this promoter. The company is actually going to go public probably in the next 3-4 months. There's a company called Concord Biotech, and uh, you know, from here when we went, we had no idea. In fact, there was nothing. There was nothing. There was no project plan. There was no business plan. Nothing. There was some person who had left Ranbaxy, was a technocrat, had good understanding of the fermentation skill that was required. It's a fermentation based API company, and he literally went there and closed the deal in 15 minutes. And all he asked, probably the gist of the two basic questions that he asked was, how much money do you need to set up the plant, and what kind of stake are you willing to dilute? That was literally, I'm sure a lot of VCs do that based on that, but of course, and he had done his homework prior. He had friends in pharma industry who had given him the feedback that, this particular skill is a rare skill. This particular guy has a good combination of that technical skill as well as a commercial mind, and one should be backing that. So obviously, I was in the dark about those things when the meeting was going on. So I was astounded at that point of time. How can you just give? I think he gave some 15 odd crores for a for 30-40%. I can't remember exactly, because after that there was again a lot of back and forth. That company got acquired by Mylan. Then Rakeshji bought that company back from Mylan, and in today's day, he still holds about 25-26% kind of stake in that company. He, as in his family, owns. So that was one anecdote that really sticks out. And there are numerous occasions when, we are all sitting in a meeting, and because he was in some kind of a medication, sometimes he used to doze off during meetings, and a lot of people would find it very, very rude. uh, but what I mean, and we used to be also be like, what, we are in a meeting over here, there's this promoter sitting who has a company which is worth 4 5 10,000 crores, and he's like sleeping. And that used to, I mean, I used to be very embarrassed about that. But he was subconsciously always there. We would ask tons of questions, but they were just ticking boxes. He would get up and ask the most pertinent and the most pointed question there would be about that particular company. And once that answer was out, then you knew, okay, you know what, this is a no go area. Why are we even wasting our time? So that is how sharp his mind was. I mean, today I can talk about this, but honestly speaking, a lot of people see, he was a man of many layers, and you have to slowly get to know him, understand that, for his first reaction is going to be violently no, then he is going to open up a little bit, and then when you go to him third and fourth times, he will give you a far more patient hearing, and he'll be willing to change his mind. So it was a process of taking things to him, and it will not immediately, he's not going to, just because you come and done some work, it's not like he's gonna listen to what you have said and change his mind. So it was a process. It's not like he was dogmatic about it. He had good reasons why he would not change his mind. But if you wanted to change his mind, it was something which you have to go over and over again and again with him. Then he would finally change his mind. I think those are the three incidences. One more, and as an aside, I mean, a friendly banter. I remember I had at one point of time picked up a stake in a company called Natco in my personal. This was after I left him, and I had gone to pitch that particular company to him. And, I mean, he heard me out patiently. I went to him twice, thrice. He heard me out, but he did not invest in that company. And he had a bet with me that, I will bet 5,000 shares of this thing, whatever the worth was of Natco at that point of time, that if I have bought Aurobindo and you have bought Natco, let's see which one does better. At that point of time, I can say in next 2 or 3 years time, Natco did far better than Aurobindo at that point of time. Just a small minor victory for a student over the teacher. But anyway, that didn't matter, because eventually, I mean, Aurobindo had a lot of issues and he sold out his stake. Natco also fell into some kind of troubles much later on, of course. But those are some anecdotes that reveal the nature of the man. He was an open book. He would have his trading positions lying right there. He would speak to anybody and everybody on a speaker phone. Doesn't matter if it is the finance minister or any corporate head honcho speaking, he will speak to him on the speaker phone only. So, and he will not hide anything. And sometimes it will make you uncomfortable that, you are being privy to a conversation that you should not be, but that's just how he was.
So, how long did you stay there?
I was with him till the middle of 2007. So 3, 4, 5, 6, 4.5 years roughly. And I mean, of course, I was working directly under Utpal Bhai. So now Utpal Bhai, I mean, I will be doing a disservice if I don't speak about him. But Utpal Bhai was completely different personality to Rakesh ji. But again, I have learned tremendously under him. He is the typical wizard who has everything mapped in his mind, organized, and he had all the right words to say. He's the one who would convert the so to say, a very raw thought process into a sophisticated presentation. So sorry, with yours, you had a question, how my initial experiences shaped my this thing. So obviously, I have interacted far more with the I don't want to say roadside, but that's how Rakesh ji used to call it. हम लोग तो सड़क छाप हैं, हम लोग तो मार्केट में कुछ भी नहीं लेके आए थे और पैसा बनाना सीखा है. But and I have interacted far less with the sophisticated version of the investors who are all MBAs with everything. So I have a very good mixture of both the things. I can understand the on ground, the pulse of the market, as well as I can understand the language that most of these large funds and MBAs and those guys speak. So that, I think, those two worlds are very different, even though they are very much part of the same market.
Sure, and I'm sure a lot of glimpses of Rakesh ji is gonna come further in all the answers which you're probably gonna give. But I'll now come to your way of doing things. And actually, my first question, usually I start with asking about how do you go about your stock picking. But I want to pick up something from your corporate presentation, which I was glancing through, and I found a very common slide nowadays, which is you start with a universe and then you filter it down, and the process is mentioned where you have started with some 400 500 companies, and then you based on some quality filter and so on and so forth. uh, and the first point there is that you filter on the basis of balance sheet quality, right? I just want to ask how this thing has evolved over a period of time, because whatever my experience myself plus my interaction with other people has been, is that thing has dramatically, it was like a switch in 2007 8 9 market, that pre 2008 there was very little to do with balance sheets, and post 2008 everybody understood the importance of balance sheet. Was it something similar for you? Was it or something was different when you were with Rakesh ji and Utpal ji, and maybe they were more balance sheet focused than the whole market was? So just run me through that part of the process.
No. Balance sheet was very much part of our analysis even at that point of time. Of course, the importance and the emphasis that we gave to the balance sheet changed clearly during the 2003-8 period. If you were too stuck on a pristine balance sheet, you lost out on a lot of investment opportunity. But that did not mean that you never looked at the balance sheet. Clearly we were in a stage where the cycle was in a bullish cycle, and it was driven by capex. And usually what happens in a capex driven cycle is that these at the bottom of these cycles, these balance sheet look broken, the businesses look shattered. So and we used to always face issues like whenever we went to meet the companies, they used to be asking like, why are you even interested in a company like ours? That is the kind. But they did not have the perspective of the cycle of the industry. So at some point, in a business cycle, market cycle, you do try to invest in businesses which might not be the AAA, never need any kind of leverage, absolutely spick and span. First of all, there are no such companies. That's a myth. But whatever the scene is, you still try to pick the better of the company even within that particular business. So balance sheet was always a focus. But yes, you are right. The pendulum really swung the other way post 2008, where people wanted to invest only in quality companies. Now, there is a difference between a great company and a great stock. I am more inclined in buying a great company, good company, average company, provided they will be a great stock. I don't want to buy if they are just going to be great company but a bad stock. So our focus is not to filter out everything in that qualities. That's why we have kept the quality filter right at the upper end of the funnel, where what we want to weed out is ugly, serious corporate governance issues, never generated any kind of wealth industries. All those are weeded out at the top of the funnel. And we still keep the quality filter. As I said, we will buy a good or a great company, or we might buy a company which market perceives as average but which we believe is an above average company. So that is where we draw the line in terms of the quality, and not right at the top where only the quality companies come out of it. So that, and then one more thing that I will draw out, which is probably different from what Rakesh ji used to do, is Rakesh ji paid a lot of importance to valuation. He would actually buy, like, of course we all know that he has bought DHFL, and in hindsight, of course, that was a mistake. He's bought Aurobindo, is associated with other companies. So his quality filter was not that stringent, but his valuation filter was very, very stringent. He would buy only and only when the valuations were totally in his favor. There was no chance of him losing money if he was right on the business opportunity. So obviously, it might so happen that some of the wealth that was generated was not a sustainable wealth, because later on those corporate governance issues do come to bite back. So one thing I do is I try to keep slightly more stringent quality filter, and I try to keep a slightly more lenient valuation filter as compared to Rakesh. Now Rakesh, he was at the other extreme of the valuation. He will, as I said, not buy anything unless the valuations were totally in favor. So this is a lesson that I've learned over the last 10-15 years, is that if you are bullish on a particular sector, a thematic, you don't have to go and buy the cheapest stock in that sector or theme. You are it's okay to pay 20% premium to a really good franchisee rather than go and buy the cheapest stock. Over and over, time and again, it has been proven that even the large companies give as much returns, if not more, and probably some of those returns are far more sustainable than the cheaper stocks or the lower quality companies produce in that particular sector. So that is just our filtration process and how it is different from what I learned from Rakesh ji.
Stoic Talks has been partnered by DSP Mutual Fund, which was an obvious choice for us, having interacted with the DSP team earlier and recognizing how they are obsessed with helping investors take better decisions. Some examples of their motivation to help investors do better are visible in their research related work, which they make available for free, including Getting Smarter, Tathya, Report Card, their Invest for Good blog, among others, and many more reports. We thank Team DSP for supporting this episode of Stoic Talks and recommend that you follow them on Twitter. Their handle is @DSPMF.
Just to give a flavor to the listeners also, is it a largely quantitative criteria, or is it a list which you have over a period of time developed that, okay, these are some 400, 500 companies we are interested in? How has this
No,
list been?
it is not a quantitative filter at all. In fact, the first way we build the universe itself is very, very subjective. First, we choose the sectors or the industries that interest us. So, for example, as of today, I mean, we not only, it reflects in our portfolio also, it's not only in our filtration process, but I have no interest in maybe metals or agri stocks or all those kind of things. We need to have a positive top-down thematic view on it. If that view is positive, then that particular sector gets featured into the universe. Now, within that also, we might look at all the companies from that sector might come into the sector, but we are interested in only the leader or the challenger or somebody who is doing something differentiated. So we are not going to, as I mentioned in the past, we have done those mistakes, but we will not go down the curve and buy the number 7 company because on valuation basis it is the cheapest. We would rather buy at number 1 or number 2 company who are doing something differently, and it's okay to pay 10-20% premium for that. That is a lesson learned in the last 10-15 years.
So I'll come to the valuation part again, but just to make it very crystal clear to the listeners also. So what you're telling me is that it's a top-down sectoral preferences. So I'm getting a sense that obviously with time that this list is also changeable. You might have
Absolutely.
favorable, yeah.
No, I'm sorry, I didn't complete my answer. Yeah, so it is a dynamic list. Um we make exceptions, like, so you used to have a very stringent filter that we need at least 10 years of balance sheet or the financial track record before we even look at it. But some of the companies that do come to IPO, we don't have access to that kind of data, or sometimes the company itself doesn't have it. I mean, a lot of companies which are less than 10 years old, 10-year-old do get listed on the market. So for example, Nika, not like it features in our portfolio, but it does feature in our universe, because we understand that this is where the puck is moving, this is where most of the new business models are going to come from, and you want to be ahead of the curve in understanding the business models. So it is important that you include those companies as well in your universe, even though they might not get featured in your portfolio for a long period of time. You start building your understanding about the company. See, this process of finally picking the stock, it's not like one particular day an idea came and next day you decided. It doesn't happen that way, at least for not for me. It is a process over a long period of time. Kind of, you have developed a perception about an industry, you have developed a kind of liking or disliking towards an industry. You have placed a particular company in a particular manner in that particular industry. So those things keep panning out, and then suddenly you see that, so now you have a positive top down view on the place. You're bullish on capital goods, you're bullish on railway, defense, all those kind of themes. And then at that point of time, you want to know technology wise which company is superior, management wise which company is superior, who has managed the balance sheet well during the downtime. All those kind of things are very quick. So that is the ready database available, that okay, this guy managed his balance sheet well, this is a superior management to this. And because that is built over a period of time because of our experiences, or either because of the actions of the management, that we have that database built. And then all you need to do is just put the growth prospects on top of it to understand, okay, is that and growth and valuation perspective on top of it to understand whether it is attractive enough or no. So sometimes what is apparently a very quick decision is because that database was already there, and then you just put the outlook and valuation perspective on top of it, or some other trigger, like a management change. Like, I'll just say it with an example. We have been tracking a company called Bajaj Electricals for a long period of time. And we always thought that, what is this management doing? They had EPC as part of the company. Then, of course, there was an unfortunate incident that the promoter's son, Mr. Neeraj Bajaj, he passed away. So there was and they were implementing something known as theory of constraints, essentially, where they were converting from a B2B business to a B2C company. So there were these things, and we were always like, it's still not right time to bet on it. Then things changed, the EPC business was farmed out. That, a corporate event like that triggers that, okay, what, we need to take a look at this company again, because we had clearly marked this company down because EPC was part of the company, and the moment that is going out, then you need to take a real look at it. But then again, this unfortunate thing happened, so you need to go and see, okay, new CEO has come in. Now you have to go and see what is the new CEO saying, what is his focus, what is his priority. And when you meet the new CEO, it became very clear that, okay, no, he's a focused guy. He's focused on turning the business around and making the company either number one or number two in each of the categories that they are focused on. And it's a 6 category company versus some of the other companies which are 1 or 2 categories, and they are either number 1 and 2 already, and he is further looking to build the brand and build on that success. So then it becomes very clear that, okay, at 12,000-13,000 odd crore market cap, and versus a leader who's probably at 70,000-75,000 crore market cap, the gap should not be that large. So you try to build that scenario. What is the probability of this company being a 25,000-30,000 odd crore market cap over a 3, 4, 5 year horizon? And I think then it becomes very clear, because we had that kind of a history with the company and the reason for not investing at that point of time was clearly identified. And when those things change is when you go and start building your position.
So this is where it's interesting, because over the years we've seen you with changing evidences. Say, I remember your presentation back in 2020 on how chemicals as a sector had become overvalued to a point. And there was a point of time few years back where you were so gung-ho and you actually killed it across. And even today, many a times you talk about themes. I remember you giving an acronym in COVID in 2020. I just can't remember the name. Maybe if you could recall.
Consolidation. Essentially, COVID was, you actually had consolidation across sectors. And it was like what we know as today as K-shaped recovery. So the top, stronger the balance sheet, stronger you became, and weaker the balance sheet, you got pushed out. So there was a market share migration happening to the stronger players. It was an opportunity more than a crisis, which I believe. There was a V-shaped recovery. Then it was in India focus or Atmanirbhar, something of that. I forget. And D is of course digitization. So all those things kind of got accelerated in COVID. So we were actually positioned in chemicals, pharma, IT, platform companies prior to COVID, and all these businesses got a huge tailwind because of COVID. However, we realized that this it's bunching up of business, but it does not look sustainable, and market is extrapolating that. And there was enough evidence on the street. You could see that. So for example, we had one particular company in our portfolio. I will not name it, but it was kind of a quasi growth, not quasi, but a proxy play on the growth of Infang, Microsoft's and Apple and Facebook and all that. And they had started slowing down already in US, and their stocks had started correcting. So it was only a matter of time that it will start featuring over here as well in the companies. Then we had again, Laurus is one company that we had picked up a huge stake. It was a big portion of our portfolio. And our hypothesis, of course, got boosted a lot by the fact that COVID drugs portfolio become a big portion of Laurus's number. But again, now COVID went away as soon as it came. It was a 4, 6, 8 quarter phenomena at best. And suddenly now we are seeing the numbers dropping dramatically. It was very apparent to us at that point of time. See, market loves the narratives, but people don't go behind the narrative to check the evidence if that narrative is right or wrong. People put too much, or rather an emotional decision that if the stock price is going up, it's a great company, and if the stock price is going down, it's a bad company or a bad management. Both the things are wrong. This good management remains good regardless of what the stock price does, and a bad management remains bad regardless of the what the stock price does. Sometimes some management do some mistakes, like in terms of either guiding, or some of them could be actually misleading also, or basically building an expectation which are unrealistic. So one has to recognize that, and you need to look at it from that perspective rather than get emotional about it and say, oh, he lied to me, or so and so forth. So yeah, I mean, I would rather be pragmatic about all these things than take emotional calls, and one has to change the view when things have played out its course, or if market is making a mistake by extrapolating something that is unsustainable. It is your duty to take advantage of that.
Very interesting way to put it. So, say, currently, we keep on seeing this. There is a duty to hold rather than duty to change, right? So, but how do you track all these changes? Because we've seen you've changed your portfolio depending on themes. You've been able to actually go gung-ho in 2020, then become a lot more sober, seeing change in extrapolation. So what is your process of tracking, or as a team, how do you go about it?
No, so first of all, I didn't go gung ho on chemicals in 2020. We were bullish on the theme, since 2014. And I mean, you have seen my presentation which I made in investing conclave, where I made a self presentation on chemicals. That was in December of 21. So, and I listed out my thesis, right? And basically, you do go into the reasons why you bought it and see whether those still hold true or no. So we were bullish on chemicals because that entire sector was available at 25,000 crores, because there were 15 companies which were growing at 10-15%, with a bottom line growing at 15-20%, and ROC is upwards north of 15-20%. Now, because of the tailwind from China, because of the pollution issues, those companies started growing at 20-25%, and the bottom line started growing at 35-40%. But it did not take away from the fact, while doing our initial research, only we were so scared of betting on the chemical sector, because it used to be a B2B sector with no knowledge of what price movements are happening at the back. which way the spreads are going. We had no idea where the profits are coming from, which particular product that profit is coming from. We had no idea. So while betting on it also, we were very scared. But then at 7 years down the line, after 20x expansion of the whole sector, suddenly people have even forgotten the fact that you need to understand what the source of the profits are. And if you go deeper, you'll realize most of these chemicals have their 30 to 70% of their turnover coming from one or two molecules, and they are a big beneficiary of price increase. And suddenly you can see on the horizon that raw material prices have gone through the roof, the spreads have shrunk, freight costs have gone through the roof, the margins that have expanded from 14-15% to 25% are not going to sustain. So a peak profitability combined with a peak valuation, it is quite apparent, right, that okay, from the next 3-4 years perspective, even if the larger trend of chemicals is going to sustain, this is not a top down story anymore. There will be correction in valuation, that is for sure. So it could be that it happens through a 3-4 years sideways move, or it could happen through, rarely that happens, mostly it happens with either a 30% fall if the companies are still very good, or with a 50 to 70% kind of a fall. That's what happens. So we are witnessing what is going on in chemicals, and that is exactly. And there was so many other risks that the market was ignoring, that there are execution challenges. The ability to vertically integrate or horizontally integrate is not an easy thing. It takes a lot of time. So many companies are coming to the market to literally cash out. 10 or 12 chemical companies got listed with an absurd valuation. So that should actually kind of flip your switch, that if the promoters think that these companies are overvalued, or they want to take advantage of the market situation, then what exactly are you don't have any kind of great insight to be out guessing them.
Yeah. Ravi, so I mean, I'm getting a sense, and I'm trying to summarize it what you just said in terms of your stock selection. So what basically you're doing is every, and it's a regular thing. There is no, there's not a fixed timing based thing that you're looking at and sitting and deciding, okay, next few years this sector is looking good. But by the very nature of continuous research, you have positive view on few of the sectors for the next few years, and you are looking at the leader or the challenger, or some, as you rightly said, I think a person who is doing something different in that industry, because that brings in the growth element or the sustainability element or the balance sheet element, being the leader. So is that a fair summarization of how you're going about looking at your stocks?
No, absolutely fair. Absolutely fair. It's only thing I would add is that this database of what Rameshji says is that you have to connect the dots, and it just all that comes through just having reading quite a lot and keep building that database in your mind and institutionalize it. Of course, we have a large team of 15 member research team, so now instead of only one or two people, a lot of us are doing the same thing, essentially reading all the time and building our database. And then at some point of time, it will click that this sector is looking good, or this stock is looking good. But you summarized it well.
Yeah. So okay, now that it's quite clear how you're going about selecting the stocks, let me also ask some questions on the portfolio construction front, right? So in your presentation, also the corporate presentation that you have on your site, you have mentioned that you're very very concentrated, right? I think you mentioned 8 to 12, if I'm not wrong, 8 to 12 stocks. uh, can you give us a flavor of how do you go about it? Because given the fact that you are going sectoral, top down, I'm sensing that you have a lot more options to invest into for next 3 4 5 years. How do you go about allocation into those selective stocks? And given that you are 8 to 12, I'm guessing your starting position could not be anything less than 5 6%. Is that fair? Or I mean, how do you go about it? Just throw some light on that.
No, so I come from a school of thought that once you spot an opportunity, it absolutely does not make any sense to be betting anything less than 5-6% on it. Of course, we need some amount of diversification, which is why it's a portfolio and not a one, two, three. We are not yet evolved. Forget not yet evolved. We will probably never evolve or graduate to the level of Charlie Munger that we can hold a three-stock portfolio. So we need some amount of diversification. And our experience says that 8 to 12 is more than enough diversification. You do not need any more stocks than that then you are basically, if your number 15 bet is going to be a 3%, then it is not going to move the needle for the portfolio in either which way. So we are very, this is one thing which is common for or the one of the thing that is I would say the base of our philosophy, which is we have to be concentrated, do so much work that you have the conviction to take a 5 to 10 to 15% kind of a bet in that particular company. Of course, then it is also the size of the company plays a role in it. We might be very convinced, but if it is a very small company, then we cannot go and buy a 15% of our portfolio. We have to still, our as a percentage of our portfolio, it might still be 5%, but that's because the size of the company is less. We might at some point of time increase it when the size of the company grows. So our, as you rightly said, our base bet size is actually 10%. If everything is fitting, growth, outlook, business, management, balance sheet, business cycle, everything is ticking the box, and you're very bullish on it. And it is also a quality company that can feature across the portfolios, then we'll go and buy 10%, when maybe, or in extreme cases might go as high as 15% also at cost. If we are only 8 out of 10 there, kind of 80% convinced, but either I wanted to buy 20% cheaper, or I'm waiting for one or two triggers to pan out before I build on my conviction, then I might pick up a 4, 5, 6% kind of a stake and scale it up over a period of time. That is how our portfolio construction happens. And honestly, it is humanly impossible to be so closely tracking anything more than 30-40 stocks or 50 stocks at best. Even with 15-member team, our real core area is 50 companies. So the filtering process from 450 to 500 companies, it comes down to about 150 to 200 companies, where we have a cursory eye on it. But our real focus is only on those 50 companies where we go really in depth, and we would ideally like to be ahead of the curve in forming an opinion. So if you want to have that kind of in-depth research, then automatically you will restrict yourself to fewer companies. Otherwise, I mean, you can have if you have a 30-40 stock portfolio, then your universe is actually going to be 150 200 stocks, and for that you will need a much larger team. It is not humanly possible. Even with AI coming in, I believe we will still be, maybe some amount of capacity increase can happen, but it cannot be the right amount of portfolio concentration or diversification is 10-15 stocks, in my opinion.
Okay, so when you start with a 10% stock, and I'm guessing that you're saying 15%, do you also have a sectoral limit in your mind at a cost level? Okay, I will not go beyond a particular percentage in a particular sector.
Yeah. Of course, we do. We will see. You want to be a sustainable portfolio, and yes, you want to take advantage of the fact that you are early to identify a sector, whether it is chemicals or defense or railway or whatever it is. If you are early to identify a sector, you want to take advantage of it. But at the same time, you also need to provide for the fact that you could be wrong. So 45% is roughly where we keep that limit. But again, we do a lot more nuanced sectoral allocation. Like, say, for example, today we are very bullish on financials, but financials is a very broad term. Within that, there is lending, non-lending, and it does not make any sense to club the two together. What difference does, let's say, for example, an exchange will it make? If exchange is a play on the overall financialization, selling of financial products in the country, while a bank is more a play on the loan being given to the retail guy or to the corporate. So what is the connection? So we actually try to be not diversify, but distinguish between what is a lending exposure and what is the non-lending exposure. How much is the exposure to exports, how much is the exposure to consumption. So we try to make sure that to a particular thematic, like say consumption or whatever, we do not have too much of an exposure. We don't want to be only based on one particular theme.
Actually, Okay, so let's say if you do have such high conviction into a particular sector, even if it's not high, you're saying that there's a limit around 30, 45%, you said, right? So 45% brings in. And you also said one thing, which is if you have early to identify it, you want to take advantage of the sectoral run. Doesn't that by default bring in a very dramatic risk that when you are wrong, and I'm guessing you might have had some experiences where you were probably a bit too early into a sectoral call, and if you have a 30%, 40% kind of exposure to a sector, just like people in cash has a cash drag, you might have a sectoral weight drag to your portfolio returns for a long period of time. Have you gone through it in past? Any examples? Is this a favor? How do you mitigate this risk, or you don't mitigate this risk at all? How do you see this?
No, so you're absolutely right. You do get into these kind of biases. However, it has not happened to us that we are early to identify, because when you identify, it is easy to build your position up. What is difficult is when that sector peaks, is that you're not quick enough to reduce your exposure to it. That is where the challenge lies. And it has happened to us in the past with pharma. 2015 is when it peaked, and 15 to 17 was a period where market continued to do well, but pharma as a sector did not do well. And the challenge lies there. I think we were not the same change that we have identified in chemical sector, we could not identify in pharma, or we did not pay attention to it. The consolidation in the US generic market of the buyers was a secular structural something that worked against the Indian manufacturers. And of course the opportunity was shrinking from the profit pools that were available to be tapped. And there used to be, on every launch there used to be 15-20 day one filers, and that told you the competitive intensity. If one particular drug is going to have 20 people, nobody is going to make money on it. So that is one particular change that we were late to recognize. I won't say we never recognized, slightly late to recognize and slightly late to act on it. So as I said, that these challenges, this discipline of this sector is more required when you have changed your V. While we are building our position, I mean, I feel there is very little probability that will be wrong, because we are not 45% exposure from day one, right? You find an opportunity, you take a bet on it, you see it working, then you realize that this is a sector wide thing, you go and place one more bet in some other company, and that is how you build your sectoral exposure. So your probability of being wrong while buying in a sector is wrong, not so much. But probability when the sector peaks, and if you don't scale back your exposure down, that is a challenge that we have to overcome.
Hi, friends. I hope you're enjoying this particular episode. I just want to take a minute and thanks the sponsors for this episode. Stoic Talks was built on a premise of actionable insights and detailed questioning, and that usually requires the independence of doing that work. When you're looking for somebody to partner with, you are not only looking for somebody who will share your ethos, but also will promote this independence of asking fearless questions without any hesitations. So, when we were looking for someone like that, the obvious first choice for me was a DSP mutual fund. I have known their team, I have worked with them for a long period of time. They have this tagline called hashtag invest for good, which I really like because it really associates, which in my observation, I've seen them living this as the way of their life, and which is very visible. If you follow their work in public, they have done some excellent research efforts. They've come up with some amazing reports which everybody enjoys reading. For example, they have this report called Netra. Then there is the transcript, which talks about the con call transcripts. Then there is the annual report Nectar, the Navigator, and many such reports, which I enjoy reading and is enjoyed by many practitioners in the investment community. So we are extremely proud to be working with such a team. They completely agree with our vision for Stoic Talks, and I really want to thank them for supporting this particular episode. And if you aren't already, I would highly recommend you to follow them on Twitter. With their Twitter ID is @DSPMF. So thanks once again and enjoy listening this show. I'm also sensing that probably there will also be a challenge that when you are slightly early into your positions, and parallelly because you're managing so many, I mean, your core is around 50 odd companies, and you're finding some other opportunities. Do you also find sometimes a case where you like a company which is already in portfolio but not really doing well because of the waiting period, and you have an additional idea which you are equally gung-ho about, and you're thinking about replacing, that existing not working stock? I mean, given the fact that it's a constant research activity, and you have ideas coming in, coming up, how do you manage that kind of a waiting period? Because the more I'm talking to you, the more I'm sensing that you are very value focused. When you buy companies cheap, there is always a waiting period, and it's easy to confuse a value trap with a with a market not able to recognize the potential kind of a thing. How do you differentiate that, if in your eyes?
So switch call remains one of the most difficult decisions that we have to take. So we are not very flippant on our switch calls. We do want to build our conviction. We do want to be very sure that this opportunity is at least 2x of what I'm currently holding. In what I'm holding, I might be wrong in the timing, but if my basic hypothesis is still right, I would still want to continue to hold on to it unless something presents itself where I see the potential to be 2x of the return and not just 20% higher or 30% higher. However, having said, I would just like to correct yourself that I don't want to put any kind of a label on myself that I'm a value investor or the growth investor or anything. I'm an opportunistic investor. I'll go where the opportunity lies, and I don't care whether it's called a growth in or a value buy market. It doesn't make any sense to me because the maximum money my whole philosophy is to make money when the growth changes to value. Value changes to growth. You want to buy when something market is labeling as value actually becomes growth stock. So that is when you want to buy, and those quadrant changes is what then suddenly everybody will try chasing it. So yeah, and we like to identify clear catalysts or triggers of what will change, when it will change, and why we should be buying at this point of time. I am never in a hurry. I'll be probably 20% late to buy, but never be 2 years early to buy.
Got it. Yeah, that's precisely where it's coming from. Okay, fair enough. Now let me reverse the question on the selling side, right? So you gave an example of chemicals across the board. The valuation started to become unreasonable, so to speak, and you, I think, had a very significant exposure to chemical at that point in time when you started drilling it down, and you also mentioned that it's very important to react faster on that side of the pendulum rather than on this side of the pendulum. So when you do react to this kind of a situation where a complete sector which is very high allocation in your portfolio, um, do you have to by default take cash calls in that case? Like, okay, the sector is becoming too much, I need to move out, but I don't have enough ideas to put money into. Does that kind of thing happens with you?
So in our case, usually the maximum I would have generated cash would be in the range of 25-30%, and maximum period that I would have held on to cash because of lack of ideas would have been 3 months. Now this is last 13 years history. I'm saying it could be different going forward, but it was not a cash call. It was an exit call on chemicals, and it is waiting for an opportunity to identify the next big thing or
Sure.
something like that. So it is not a conscious cash call that I am. Cash call is something that I would categorize that there is going to be a recession in US, so I need to create cash across the board. We don't take those kind of calls very easily. Those are once in a decade call, and we don't want to take that very easily. So only when you believe that the business cycle, the market cycle, the leverage cycle, everything has peaked out, profitability cycle has peaked out, and it's time to be away from the market from the next 3 years point of view, is when we would like to take those kind of calls. So to give you a perspective, in last 30 years there have been three such instances. Harshad Mehta peak at 92, dot-com peak in 2000, and global financial, just before global financial crisis in 2008. Now if you constantly have that at the back of your mind that, oh no, there is a recession coming in US, this is coming, that is coming, then invariably you will keep creating cash all the time. So we don't want to take that kind of a cash, and it's okay if I'm a little late to realize that or understand that there is a big crisis happening. But once you realize that there is a crisis, it's okay to act fast on it. So we will be very, very conscious when we take that cash call. Usually it will be about getting out of a company, getting out of a sector, and waiting to find another opportunity.
Over the last 13 years, when has been the time you've made some exceptions from your, say, something new comes up, right? For example, we may never buy IPO stocks. We may never buy this sort of sectors or this sort of companies, or some exceptions which you've made over the last 13 years. Uh, and how did you go about it?
So, in Rakeshji's office, there was one particular quote, and he had rules for investing. And number one rule was you have to be optimistic. But the last rule, which not many people know, is that there are no rules to the game of investing. So we make a lot of exceptions all the time. But I mean, I won't say they are exceptions. It's just that, so like, people get stuck in their philosophy that this is my core competence and I will never look beyond that. We don't come from that point of view. Since our philosophy is that we are opportunistic, my philosophy is to understand that opportunity, understand that space, and build a core competence before anybody else does. So if I don't understand chemicals, I need to understand chemicals before anybody else does. If I don't understand defense, I don't understand railways, I need to understand it before anybody else does. So I like to say my core competence is reducing the time between understanding of a sector and placing bet on it to the as much quickly as possible. That is how I would say. So that leads me to make a lot of exceptions. Uh, uh, IPOs also, it's probably overpriced, is a very general statement. But then there are sometimes some companies that come to the market which are kind of an exception, which are kind of a must-own companies, and they might not be coming at an absolute cheap level. But when you put yourself with a 5-10 year perspective, you realize that you need to be owning these companies. So I'll give you an example of Radhakishan ji, and I mean, we are all familiar with Rakesh ji and his, but not much is known about Radhakishan ji. So Radhakishan ji bought, I think, probably 3 or 4% of Jubilant Foods on the day of its listing, and it was an expensive stock to begin with in IPO, and it listed at a premium, and he bought almost 3-4% of that company. So that got me thinking, like, how can a deeply conscious, value conscious investor like Radhakishanji buy a company like Jubilant Foods, which has never been cheap in its life, on day one? So, and then once you realize that he is coming from the perspective that it's a 100 store company, 200 store company, there's a long runway, they'll have 2000 stores or a 5000 store at some point of time, much larger scale. It's a franchisee that has done well elsewhere. Pizza as a category will easily be kind of acceptable in the Indian populace. All those kind of things, when you think about it, then you see that as compared to the opportunity that lies ahead of you and the quality of the franchise, you don't need to worry about 1 year, 2 year valuation. You need to really be thinking long term, and you need to be picking up stake in that. And so there are times when such exceptional companies come to the market, and you need to be buying them, even though from a year, 2 year perspective, it might not make sense. So that is why you should not be overly focused on the current year earnings or the next year earnings. In fact, Puneet, you said that kind of I'm a value oriented investor, but if you were to go and check the PE of my portfolio, it will probably be north of 40. So I don't think most people would agree with you that we are value oriented investors. But it's wrong to be looking at a PE multiple. See, PE is an derived number rather than something that you take as a starting point for doing your investment. I think a lot of people get caught up in that. You have to, one thing that I learned from Rakeshji again is that you don't pin down the valuation of a company in sheer numbers, as in the PE multiple or something. You look at what the opportunity size is. You look at what scenario this company can possibly create in a 5 year, 10-year horizon, and then as compared to that opportunity, where are the valuations today? Then it will be very clear to you that this company will someday be a 30, 40, 50,000 crore market cap and it's available at 2,000 crore. Even if it is 40 multiple, it does not matter. The stock might not do anything for a year. That's your worst case downside. But over a 5-10 year horizon, if you can have a company that can be 20,000 crore market cap, then don't worry about 1 year performance. I think that's how I think about valuation as well. And there is no one particular way of valuing a company. You have to apply all possible ways of valuing it and see which fits the best in those particular circumstances.
In fact, my next question was going to be on valuation itself, because this word has come up so often, and a large number of our listeners will be on the in the nascent journeys of investing, and valuation is one thing which can be made as complicated or as simple as you want it to be. uh, and since you have said, I'm okay to pay 20% above my valuation, above the valuation of the company, it is such a esoteric number that most of the investors, they say, "Yaar, it's a feel, it's not really something which we can put a number to per se." Um, and and the last answer which you gave also gave a lot of detail on that. Can you pick up any example, historical, current, anything, and just run us through how you quickly think about valuation in your mind? And also, in the very starting, you made a statement from Rakesh ji, which I have noted and probably going to print it, is that don't focus on potential, focus on probability, or something of that sort, right? So how do you bring that into this? Because at one point we are saying, look at the potential. 10 years down the line, it could be a very big company, and obviously you are going to build it into your valuations which you're going to pay. And on other side, we are saying, well, don't pay too much for the potential also. So how do you bridge that concept in your mind?
No, clearly it is a potential as well as the probability. If something has a potential of being 100x, but the probability of that is 10%, you don't want to go with that. But if something has a potential to be 10x and the probability of, let's say, 70-80%, then that is what you want to go with. Again, I also made one more statement which you should highlight, is that if you are wrong, you should double your money. So that is the kind of probability. So see, when I say potential, so whether Jubilant Foods will become a 2000 store or a 5000 store company 10 years down the line, we have no idea. But we know it will be much higher than wherever it is. And I'm talking again from the day when the IPO happened. From that point of view, that call was not that it has to be 2000 stores in the year 2023 or something like that. We don't get caught up in those preciseness of the predictions. We are the scenario or is so probabilistic that even if only 70-80% of it is achieved, you will be still far higher than wherever you are currently. So, and if that is the scenario, you will make your money. It might not be that you might not make the best money, but you will still make good money on that. And those are the cases where probabilities are in your favor. So for example, you asked for an example. Natco Pharma, when we picked up, it was probably quoting at around 1500 odd crore market cap. There was a potential that one particular drug, Copaxone, could earn them 1000 crores profit. Now the odds are such that 1500 crore market cap company, and you don't want to be betting really on a one particular drug. That would be very I don't know, 1 or 0 kind of an outcome. But if you have that kind of an optionality which the market is not factoring in, and then there is some base business where if you even on the base business you could justify that this 1500 crore odd market cap company could be a 4-5 thousand crore market company without that optional paying up for that optionality. So in your base case you should be able to justify uh, doubler in 3 to 5 years time, and then there should be added a optionality which can give you that kicker where you can, instead of doubling, it ends up being 4 5x or 10x because those optionalities panned out in your favor. So that is how I think of it in terms of valuation, in terms of probability. And honestly, it's an art and you cannot pin it down to a number.
Sure. Sure. We're taking a lot of time, but I'll just quickly ask a couple of questions which I have kept for last. Actually, one, in the very starting, we were talking about your learnings from your brother about technical analysis per se, but more towards demand and supply, and you have appreciated the importance of demand and supply. How do you bring that element into all the investment framework which you have discussed so far, with any examples if you can, and then I'll go to my last question.
No, so clearly, overall, in the market perspective, now today, uh, market are at a new high, and it is a very good example that people feel. See, a lot of people are very loose with words. New high, euphoria. Uh, 20 multiple expensive. So, and people don't pay attention to that pulse of the market is missing. You need to be more nuanced about these things. The markets are at a new high, and in fact there is no euphoria at this point of time. There is it's not like we are bursting crackers or people are going out and making crazy buying decisions in their own household, or we have been making hand over fist money for almost 3 4 5 years in a row, and now on top of that, and on the basis of my PNL in the market, I'm going and making some life decisions. All those things are not there. It's not the classic anecdotal evidence of a euphoria or bubble is just not there. So when people say euphoria, I mean, or for that matter, when people say panic or blood on the street, also, I mean, a 5% 10% correction is not blood on the street. So you have to be very cognizant of whether this is a 2 sigma event or a 5 sigma event or a 6 sigma event. So market's job is to oscillate between extremes, and in between actually it does not make any sense trying to predict. Only at extremes you can be very sure that this is an extreme and this is an extreme, and those are the points that you want to really say this is an extreme downside, nothing will happen, you have to put your money to work over here. Or on the other side of the extreme also, it has to be 2 standard deviation, 3 standard deviation, and it has been going on for so long that people have forgotten the word risk, something that happened in the case of chemical sector, that people forget, and 70 80 multiples become part of the parlance and par for the course, and people start taking it as a granted. That is where you have to say that was this is extreme and it is not going to sustain. Or COVID times, when it was so down, it was falling 1,000 points at a time in Nifty, and there came a point where if Nifty was to fall 1,000 points a day for 7 more days, it would go to zero. Now, obviously, that kind of a thing is not going to happen, and that is where you need to come and say that come what may, doesn't matter. I don't know how COVID is going to pan out. Market might close down tomorrow, but this is an extreme scenario, and you need to put your front foot forward and take buy decisions. So you are better off taking call at the. You have to recognize those extreme moments, and that's what I use the technical analysis for. That this is an extreme. It's not gonna go any further than it. It's a matter of days that market will bottom, or it's a matter of weeks. That's all the difference is going to be. And honestly, even if you had called the bottom of the market at 9,000 Nifty, and after that it fell to 7,000, 3 months down the line, 6 months down the line, it didn't matter, right? Because the market went way more ahead of that. So you have to. It's okay if you don't get the exact bottom. It's okay if you don't get the exact top. But you need to be aware that these are extreme on the down and this is an extreme on the top, and you need to be out of the game. That's all. In or out of the game, whatever it is.
So, do you think this period of, say, from your brother to seeing 2008 helped you to be publicly bullish in 2020? See, all of us were bullish, but how many people actually went on TV? And so, I remember you were more on TV telling this is bullish, this is this. I think 2020 was the time when you were. So, do you think 2008 also was a factor in that understanding the pessimism as well as.
Absolutely. I think I have lived through 2008 firsthand. And honestly, I mean, at that point of time, I was not a public fund manager. So I used to do a lot of trading on my own. And I have, not many people know, but I was short on the market. I have learned a lot from, of course, from a distance from Radha Kishanji. And And I very clearly remember once, when do you actually sell? It is like in technical analysis, it is when a market makes a peak, it corrects 20-30%, it rallies again to test the peak or just falls off reaching the peak, and then it falls again. You still don't go short on the market, but the first low that market made gets broken, and that is when you know that the game is over. I mean, and then nothing will come. If you were, it's foolish to be trying to time the market from by identifying the top. But once the top is in place, it is pretty clear and pretty evident, and the game, markets will collapse under its own weight, because so many people have bought those same stocks at leverage, and they are all in losses. So in the first round, people come to try and support the market or the stock or whatever it is. The market rallies, they are in the money, but once that particular level is broken, is that their new incremental bet is also under loss, and that is when you know that this is not going to sustain. So now this is not a that trader mentality. I don't use it on a daily basis in my portfolio or investing style, but this is something that makes me alert at a point that if I am bullish on the market and such something like this has happened, I will question myself and I will really go down and ask whether my hypothesis is right or no. And if I'm not, then I need to change my mind. One has to be cognizant of that fact. So I don't profess trading on charts. I mean, I know Nuresh does that or whatever. A lot of people do that. It's great. They can do it. I would say charts tell you what is happening. They don't tell you why it is happening. And I want to go that one extra mile and understand what is happening and why it is happening. If you can understand that, then you are on top of the game and you will be ahead of 99% of the crowd.
Absolutely. That is why there is a saying in technical analysis, don't ask the why. You're not capable enough to answer it.
Yeah, but I mean, I don't like to call myself a technical analyst. So I want to go behind that why.
And that's the reason you go beyond it. The whole point is, see, I was asking this, 2008. So we've seen, once you've seen a terrible cycle, that is where you get the next cycle right, in terms of bottom, right? You can't expect you come into the markets 3 years out, you'll be able to get all the cycles right.
Yeah. No. In fact, a lot of people say that, see, I came into the market in 2002, late 2002, early 2003. And after that, 5 years bull market. So I'm a product of the bull market. A lot of people think that is a negative, because eventually you will not get you might not be able to recognize when the markets turn, or you are inherently always optimistic and bullish. But I have lived through the entire 2008 being short on the market, so I know exactly how it is. Even markets' job is to move from extreme to extreme. So don't be very logical about market has to bottom out here. Market don't bottom out where it is very rarely fairly valued. It is always extremely overvalued, and it will go to the extremely overvalued. So if the swing on the upside was way more than it should have been, then the swing on the downside will also be way more than it should be. So you have to wait it out and wait for that last bull also to give up, and there will be absolute blood on the street, yours as well. That is when you'll get a good amount of time to build your portfolio. There is no hurry to catch the absolute bottom.
Sure, sure. So, Ravi, one last question from my side, and then I will let you go because we've taken a lot of your time. Um, you know, can you run me through a couple of your large mistakes, which you classify yourself in your large mistakes library that you have done, and which have probably changed or had a lasting impact on your investment framework? Any cases or any particular anecdote you can remember which you classify as your biggest mistakes?
See, there are lots of mistakes I've made in my life, first of all. Let me admit that. But it is usually only the errors of commission that gets featured in your portfolio. But it is usually the errors of omission that pinch you the most. So I would say, hands down, the single biggest, largest mistake I've made in my life is selling out Bajaj Finance too early. And I'm sure a lot of people can identify with that. It will be their largest mistake as well. And it is precisely because I went with those headline numbers of 4.5, 5 times book is very expensive, and I have the money, 4 5x my money in a span of 6 12 months. One needs to be careful. Not trying to understand the size of the opportunity, not trying to understand what exactly this company's DNA is and how special this company is, and hanging on to what you have bought. I mean, that is, I think, I would consider as the biggest mistake of my life. Having said that, I have done enough number of mistakes on the other side as well, where I have bought things that I should not have bought. But fortunately, over there, one thing always sticks with me. Rakesh ji said, make mistakes that are affordable. And fortunately, all of those mistakes on the buying side have been affordable mistakes and not unaffordable mistakes. I would like to continue with that. The way we have changed our philosophy is that we will only bet on those turnarounds where the turnaround can come through the cash flows of the company, not by selling off assets. The cash flows of the company should turn it around. And second of all, that intent and the turnaround should be on the horizon. And I don't want more than one turnaround in my portfolio. I will never have a portfolio of turnaround. I mean, borrowing from Nuresh's terminology of chor bane more, I will have only one potential more in my portfolio. I will not have a portfolio of mores.
Very helpful answer, Ravi, and really insightful talk, at least for me. I'm sure Nuresh also enjoyed, and I'm sure listeners will also enjoy. Thanks for giving us your time. It was wonderful talking to you.
The pleasure was all mine. I really loved the way you guys are conducting this, and it really uncovers a lot of aspects of investing and personal journey, which usually don't get covered in the regular formats, 15, 20, 30 minute format. This needs a very, very long conversation, and I think you've done full justice to that.
Thanks a lot for giving us that much time and being candid. And that is what we all need. Your candidness actually gives learnings to everyone. So your 20 years comes back to people in 2 hours. So that is the motive. Thanks a lot.
Thank you so much, guys.
Thank you, Ravi. Thank you. Bye bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.